Hello and welcome to an FXTimes daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, February 19, 2010. Yesterday, in the euro-dollar pair, we saw the greenback gain against all of its rivals as the Federal Reserve upped its discount rate by 25 basis points. The move came as a bit of a surprise to markets, but it definitely favored greenback strength. We hit a new multi-month low at 1.3545 in the overnight trading, but then as we got into the New York Friday session, the euro managed to rally as the news about the discount rate meant that the economic recovery in the U.S. is healthy enough for authorities to begin withdrawing the massive monetary stimulus that they have pumped into financial markets. Therefore, we had an increase of risk appetite and commodity prices and equities were higher. That boosted higher yielders and commodities linked to growth, as well as the euro. Now, despite the late euro rally in Friday's session, the euro still faces some strong headwinds as eurozone countries continue to struggle with massive debt, and while the economic picture in the U.S. is increasingly brightening. So, in a battle of the two major currencies in the currency markets, it seems that the greenback has the advantage. For the week, we are going to end up roughly where we started, which was around the 1.3640 area, if we close near where we're testing right now, which is 1.36. However, the momentum is with the greenback as the middle of the week saw very positive U.S. industrial production data and housing data around here, and that was followed by the Fed's move to increase the discount rate. So we may now be retesting the 1.36 level as resistance after it had acted as support in the beginning of the week. So yesterday we saw the Fed bump up its discount rate, which is the rate that the central bank charges for short-term loans to other banks and financial institutions. It raised it by 25 basis points to 0.75%. The Fed also changed the maturity of these loans back to overnight from what they were currently, which is about a 28-day window. In our coverage last week, the Fed did signal this move during Fed Chief Bernanke's speech 2 weeks ago, but markets had anticipated this move coming at the March FOMC meeting. So it seems that the Fed is increasing the pace at which it wants to normalize its monetary policy. This is one of the steps the Fed will be taking in order to close the emergency lending programs it set up after in a result of the financial crisis. The Fed did emphasize that the modifications are not expected to lead to tighter financial conditions for households and businesses, and did not signal any change in the outlook for the economy or for monetary policy. What the Fed is trying to accomplish is to encourage banks to seek short-term borrowing from private sources rather than the central bank. Today, meanwhile, we had CPI data come out for the month of January, which was consumer prices, and we saw a 0.2% increase on the month, which was smaller than expected. The annual rate saw a 2.6% increase, which was smaller than what we had seen in December. What's interesting to note here is that core CPI declined 0.1%, which is the first time that the monthly CPI has dropped since 1982. What the data indicates is that the recovery is generating little inflation. So restrained inflation allows the Federal Reserve policymakers to keep the benchmark interest rate close to zero in order to help support the recovery. So right now the Fed's normalization is not being pushed by higher inflation, but instead better signs coming out of the economy. Turning to the pound-dollar pair, we saw a sharp slide in late New York afternoon trading yesterday as a result of the Fed's actions, and the pair hit a low at 1.5340 following disappointing UK retail sales report for the month of January. What we saw this week was a break out of this consolidation pattern we had seen since early February, and we moved below that following the Fed's move. The UK did manage to pair some of its overnight losses, but if we look at a horizontal resistance level, it is around the 1.5550 area. So that could be an important level for this pair to test as a power line, meaning that it it changed its role from support to resistance. So we'll see if we have a test of that level early on in next week. So while signs are pointing that the U.S. economy is dragging itself from the depths of the financial crisis, the U.K., however, registered a steep and unexpected drop in retail sales in January, which sent the pound-dollar pair, as we saw, to a 9-month low. UK retail sales fell 1.2% and rose 0.9% on the year. That was the sharpest monthly drop since February of 2009. Forecasts had called for a 0.5% decline in the monthly measure and a rise of 1.1% in annual terms, so obviously both missed expectations. Now, weather may have played a role in this weaker than expected report, as it was extremely cold during the month of January, and it seems that consumers were less inclined to go shopping. In Canada, meanwhile, retail sales rose for the month of December 0.4%, a rebound from the 0.5% decline we saw in November. Core retail sales, which exclude autos, rose 0.4%. Consumers are key to Canada's economic recovery, with the Bank of Canada estimating that they will account for more than half of a 2.9% expansion this year. The country's unemployment rate is lower than in the U.S., and Canada's banks have continued to expand lending to individuals. So we're seeing a bit of a more resilient Canadian consumer driving growth than in the U.S. We also had indicators tracking employment and the economy's outlook improve in today's session, which supported the central bank's view that consumers are recovering from the country's first recession since 1992. The positive Canadian data and a move towards a risk appetite for higher yielders and growth-linked currencies in New York trading helped the Canadian dollar to sharply reverse its losses it faced in yesterday's session. We tested resistance around 1.0530 and moved all the way down to our support from yesterday's session around 1.04. We actually dipped a little bit below that to set a low at 1.0386. As you can see, that continues this move in favor of the Canadian dollar that we have seen since February 10th. Now look at another one of our commodity currencies, the Australian dollar, here versus the US dollar. We saw a more gradual rally in today's trading as it started overnight, but here too we paired a good amount of the drop in favor of the greenback from the Fed's decision yesterday. We had our resistance for the week is here around 0.9030, and we have found new support around 0.8880. So we look to close the week above this important 0.8920 area, which we had identified as a level of support that had turned to resistance and now seems to have become support once again. So let's add a third line here, and we could see that we're progressing in a bit of a step fashion as we first break above an important level, then retest it as support, and we'll see if that pattern continues in next week's trading. Now let's take a look at the key releases to expect next week. In the US on Tuesday, we will get data on consumer confidence. That'll be followed on Wednesday by new home sales, as well as Fed Chairman Bernanke testifying in front of Congress. Thursday, we get data on durable goods orders and weekly jobless claims, while Friday we get our second release of fourth quarter GDP, as well as existing home sales, the Chicago PMI, and the UMich Consumer Confidence Index. Around the world, Tuesday, we can expect Germany's IFO Business Climate Index, as well as a UK inflation report hearings. Wednesday, Australia posts its private capital expenditure for the fourth quarter, and on Thursday, Germany releases its unemployment report. Friday, from the UK, we get nationwide housing prices, as well as the final version of fourth quarter GDP figures. So that will wrap it up for our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you a great weekend.